So what I'm going to do, due to popular demand, we wanted to take you through the financial related KPIs that we've got in the optimal dairy systems, and just go through in a little bit detail, just to bring you all up to the same sort of level in terms of knowledge about them. So what we're going to do is firstly, obviously, what do we want to get out of this webinar? So I'll just take you through what hopefully you should get from it and the knowledge that you can take away. Then we'll go through what are actually those financial KPIs as part of the optimal dairy systems, and then we'll go through each of those KPIs separately in a little bit more detail. So I'm sure there'll be questions you'll have about those, so we can look at those in turn. And then we'll have the quiz at the end. So hopefully you'll all be paying attention and taking notes, and we have a sort of fun quiz at the end, which hopefully will help you retain some of that information we'll be going through anyway. Okay, right. So let's rock on, and basically let's go through this first slide about what hopefully you can go away knowing from what we're going to go through today. Well, firstly, is that you'll recognise which of those KPIs are financial KPIs, financial related KPIs, and whether we class them as dairy enterprise KPIs or business financial measures, according to how we do it under the optimal dairy systems. Okay. Hopefully you'll also know and go away knowing why we've chosen those KPIs. What's our rationale behind including them? So those are the two key things hopefully you will go away knowing. But in addition to that, you'll hopefully have a better understanding. You won't retain all the detail. You know, there's a bit there to remember, but hopefully you'll have a better understanding of what those KPIs measure, what's the evidence behind why those KPIs are important, and how we're measuring them. Okay. And of course, you know, we can give you the presentation after the webinar, so that you can use it to your heart's content. The way I've sort of formatted the slides is that you can hopefully use them for other things, maybe farmer presentations, etc. So that you know, if you want to go through these KPIs at a farmer event, you'll be able to do that. Right. So let's start. So firstly, the optimal dairy systems financial related KPIs. So these are the KPIs that we've put together for the block calving systems. We've also got a set for the all year round systems, and then we've got some generic KPIs which cover all systems, and they're our business financial measures. So just to give some background, I'm sure you might have been told this before, but just to make sure everybody's again up to speed on the same thing. When we looked at these KPIs and what KPIs there were out there, we came up with a list. So there's a group of us internally from different sectors, different teams, which basically found there's at least over 80 different performance indicators being used out there. And so that was our starting point, and then we had to try and narrow it down to what would be our key performance indicators. So this is what we came up with, and the sort of rationale behind this was really trying to get KPIs which were covering different areas of health, fertility, finance, longevity, etc. So it was a mixture of KPIs that cover those areas. The other thing just to make a note of is that none of these KPIs that we've got here, we've not made any of these up. I think sometimes it's, I think some farmers probably think that AHDB have come up with these KPIs. We haven't. These are measures which are already out there and being used to one extent or another in the industry. All we've done is just pick the ones we felt were the most important. Okay. Before I move on, is that okay with everybody in terms of that background, in terms of where we arrived at those KPIs?
Yeah.
Yeah. No, that's
okay. Right. So what are we going to look at today in terms of those financial related KPIs? So we've got there the overheads as a proportion of dairy income, and that excludes rent and finance, and we'll go into that in a little bit more detail shortly. And that actually is including both the block calving and all year round dairy enterprise KPIs. Then we've also got the total purchase fee costs, which is in the all year round dairy enterprise KPIs. And then we've got all those business financial measures. So those KPIs are our financial related KPIs as part of the optimal dairy systems. Okay, so I'm going to go through now each of those in turn, and we'll start with those dairy enterprise KPIs to start with. So we'll start with the overheads as a percentage of income. Right, so what's the definition of that? The definition is the overheads of the herd, but excluding the rent and finance as a proportion of the dairy related income for milk and livestock sales, and that could also include compensation from TB reactors as well. Okay, so that's our definition. What is the rationale behind having overheads in there? Well, I'm sure those of you that have got interest in cost of production, that you'll know that overheads or fixed costs are the biggest proportion of costs when it comes to cost of production. And also we see the biggest variation between the top and bottom 25% of producers in the overhead costs. That's where we get the biggest variation. So it's a big contributor to the profitability and cost of production. The other thing is, in terms of overheads, in terms of how we've defined it here, is it's actually widely used in comparable farm profit benchmarking. Is everybody aware of what CFP benchmarking is? Has everybody come across it? Does anybody want to sort of go through what that involves?
That's fine. I think I've come across that.
Okay, so yeah, so if you've all got some appreciation of that, that's fine. I wasn't going to cover it in this presentation, but we can do if we want to. Okay, so because it is wide, it's something you can pull straight out of comparable farm profit benchmarking. It's widely used. It's relatively easy to get to for those who do that, but hopefully it's not too difficult for those who don't do that either. So just to sort of back up in terms of yeah, that's just a little aside joke there. The evidence that we've seen in terms of why overheads as a proportion of income is important is this. So what I've done, I've taken the data we've got for the last 5 years. So that's the Promar data and a year's worth of milk bench data, and we've ranked those systems by the net margin. So I've got their top 25% average and bottom 25% for each of those systems. And so what we can see there, the blue bars for each of those systems show that they're an average over the last 5 years, overheads as a percentage of income was around 34–35% for that top 25%. Okay. If you look at the bottom 25%, that sort of lightish green bar, you know, is almost double what we see with the top 25%. So there's a huge variation, very significant difference between the top and bottom. So so their income, basically those bottom 25%, their income, most of that goes towards just covering their overheads. That's before you take into account any rent and finance. Okay, so so if you include that as well, it's even more. So that's why it's quite a significant performance indicator, that if you can keep those overheads as a proportion of income relatively low, you've got a good chance you're going to be performing well. Okay.
Can we ask questions, Mark?
Yes, please do. Yeah, please do.
How many farms would be in the top 25%? Did Promar give you the number of farms that they take this data from?
Okay, so a little bit of background about the data we get from Promar. We get around 330 farms a year from Promar.
Right.
Now that Promar data isn't just Promar clients. We actually get data from other consultancy firms as well. And the reason for doing that is so we can get a stratified sample. So we've specified that we want a stratified sample based on 5 or 6 criteria. So I get the anonymized individual farm data for all those 330 farms. Okay, so that then allows me to sort out that data however we want. So one of the things is I can separate that according to carving pattern. We've actually this year getting more block carving herds in that, because we've not got as many as I'd like in the main data sets, but that's not included in this. So in the top 25%, you would get for the all year round, you'd have about 80 herds in there for the all year round. That would be averaged over the 5 years. For the spring carvers and the autumn carvers, it'd be less than that. You're talking more like sort of about 15, 20 herds, purely because there is less anyway. So, but you can see that, you know, the trend between those different systems is very similar, despite that difference in the size of the data. Okay,
Yeah.
that gives me, so that's what I always look at. I always look at if you compare the ranges, and the ranges look what you expect, and comparing with other systems it's about the same, then I've got confidence that that data is robust enough to give me that indicative feel of what we see here. Okay.
Yeah.
Is that okay, Brian?
Yeah, no, that's very clear. Yeah, that's good. Excellent. Thank you.
Okay. So that's our evidence of why overheads is important. Let's go into how we calculate it now. Okay, so what I've done, I've broken it down in quite a bit of detail. I wouldn't expect you to remember all this detail, but you'll obviously have the slides to be able to go through at your leisure. But I wanted just to show a calculation of how we do that. So firstly, it involves both income and overheads, of course, because it's overheads as a percentage of income. So income first. What does income include? Includes those items of milk sales and livestock sales and any other dairy related income. And that could be, I know there's been some questions about that, that could be muck that's been sold from the dairy herd to an arable unit, and it could be TB compensation, for example. But that would be included in income. And then overhead is labour, power, machinery, administration, and property costs, basically. It doesn't include rent and finance. So CFP benchmarking don't look at rent and finance. Now it's a way of it's a way of really being able to, well, there's two reasons for it really. One, it's a way of comparing between farms. You're taking out that sort of structure cost, which is rent and finance, and you're purely looking at the operating costs of that farm. So it's just a different measure of comparing. Another reason for doing it is people don't always like to readily share what rent and finance costs they've got. Although I find that with some groups of farmers it's not necessarily an issue, but with others it is. So this is the income and overheads then, and simply what you do, divide that overheads by the income and then times by 100 to make it a percentage figure. Okay.
Mark, can I just ask
Yes.
about the overheads? Would it be true that the lower performers, they're the ones that are spending or have got higher costs in the power and machinery element, or is it spread across elements of overheads?
So what we've seen, and actually we'll be putting this in the evidence report, is that the labour is the biggest cost, and they'll tend to have more unpaid family labour in the bottom 25%. So that suggests that they tend to be more family farms rather than using employed labour or employed herd managers, for example. But when you look at the time they spend per cow, they spend a lot more time per cow than the top 25% would. So labour is probably the biggest, closely followed by power and machinery.
Yeah.
And one of the biggest areas of that particular item is the contracting costs. So the bottom 25% seem to have high labour costs and high contracting costs, which doesn't really make sense. Generally, good businesses should have lower machinery costs, but they may have high contracting costs. Poor businesses have both high contracting costs and high machinery costs. So they're not utilising somehow what they've got to the best effect. Is that okay?
Yep, thank
Mark,
you.
sorry, Becky, go ahead.
No, I finished. Thank you.
Mark, where does personal drawings come into overheads? Under
No, no. So what we do to standardise it, we value the unpaid labour at £30,000 per full-time employed person. Okay, so that's what we've got here. So let me just, I'm going to try and use this highlighter tool here. So you can see here we've got unpaid family labour to standardise it so that you don't manipulate the figures. If you standardise it at £30,000 per person, if it's full time, obviously if they say spending half their time on that, you put in 15,000. But that's again, that is something which it tends to be used with CFP benchmarking as well. They'll tend to standardise that. And quite encouragingly, when we had the open day at Ditch's Farm, the Tuckers were involved in a CFP benchmarking group, and they said they used 30,000 as a figure for their unpaid family labour. So it's something that we're comfortable to use, and it's a figure which we'll use in Farm Bench as well, and we are using in Farm Bench. So it's consistent across all that.
So can I ask a question, Mark? In terms of the labour, the 30,000 you're talking about there, that will not be shown on the accounts as the set of accounts. That's a theoretical figure that's put in.
That's correct.
Based on common knowledge.
Yes, absolutely,
right.
Absolutely. So you work out how much family labour is involved in the business, in terms of full-time equivalents, multiply that by 30,000.
Right. So in this case, you're looking at maybe looking at 25,000 paid labour and one person at 30,000.
Yeah, exactly.
Right.
Yeah,
that's fine.
Right.
Okay, thanks.
Yeah. Okay.
Can I just ask one last thing on that? If someone is paying themselves, but they are not paying themselves 30,000, do you bump it up or not?
So when you're saying paying themselves, so there's actually a salary that they're taking out of the business. It's not private drawings.
Yeah.
Okay, if they're taking a salary out of it, then that will be paid labour.
Okay, so and if it's 20 grand, for instance, then, but they are paying it, then
I would take it to the value they're being paid at. So because, for example, if you've got paid employee in there and they're only being paid 20,000, you won't bump them up to 30,000. So if they're actually taking out a salary, then use that actual figure. If they're not, then use 30,000 as a sort of standard figure.
Thank you.
Okay. Any other questions? Okay.
Just
right.
A strange one, Mark. So let's say your gross margin for your arable operation, say you were growing some whole crop, the pound machinery costs there, would that would be reflected in the gross margin, would it not? Fuel and that as a variable cost, or would it be reflected here as an overhead cost in the gross margin?
So if you're growing a whole crop for your dairy enterprise, the machinery cost would be included here in overheads.
In overheads, right? Okay.
Yeah. Right. So I'll come on to that question when we look at full economic cost of production, if that's okay. That's where it's relevant. Yeah. So
right.
Okay. Right. Let's have a look at total purchase feed costs next then. So the definition of that is all purchase feed costs, and that's concentrates, young stock feed, and I'll include milk powder as well for calves. Purchase forage, bulk feeds, and short-term grazing, and short-term will be defined as anything less than 12 months. And then all that's divided by the total milk produced to get a pence per litre cost. Okay. Why have we chosen that? Well, I don't think it's any surprise that purchase feed is one of the highest costs in a dairy system, individual costs that is. So it sort of sticks out as something which can be looked at and can be interrogated to see whether you can make the most of the feed. And if you've got low purchase feed costs, that would indicate then that you're getting cheaper feed from other sources. That might be from homegrown forage. It might be from whole crop, for example, if you're doing that. But what this KPI looks at, it's a cost. So cost means quantity times price. It's both those things. So it's not just about the amount that's being fed, it's also about the price being paid for that feed as well. Okay. Any questions on that before I move on to the evidence?
I can ask one more. Oh, sorry. Go ahead.
I just sorry, Ian. It was only a quick one about beef calves. So, at what point is a calf taken out of the dairy system? So, when you're looking at milk powder, for example, then presumably you take that calf out of the system at 4 months old or thereabouts.
Okay, so yep, so if it's a beef calf, obviously it's coming out of the dairy system, you take that out at weaning. If it's a dairy calf that's obviously going to be reared and come back as a replacement, that's kept in. So this is looking at the whole dairy herd. So not just the milking cows, it's also the young stock as well, which will be going into the dairy herd. But anything like beef calves would be taken out at weaning.
Okay, my questions in terms of the short-term annual grazing, if you're taking rental over 364 days, as is done for legal reasons, would you take that as short-term grazing or would you take that as rental?
If it's, would that be something taken just for that year?
Yeah, it would be just taken for that year, but they would renew it the following year, and it's done for other reasons.
Okay, in that case, I would take that as a rent.
Right.
Okay. Repeated. Yeah. Yeah.
Right. That's fine.
Okay. Right. So let's have a look at some evidence around that then. So this is, again, I've taken 5 years worth of data here and done this scatter plot. So this is, look, so we've got along the bottom, we've got the variable costs for the individual farms data we've got in here, and we've got the total feed costs up the side. And if you just correlate those two things, what this is telling us is a very strong correlation between high feed costs and high variable costs. No surprise there, but you can just see that strong relationship between the two. So feed cost is obviously quite a high proportion of the total variable costs. But you can see there is some variation. When you sort of break that down, so our sort of KPI ranges for total purchase feed costs are, if you're good, then you costs are less than 8 pence per litre. If you're in that sort of middle bracket, then you're 8 to 10 pence per litre, and then we'll say anything over 10 pence per litre is high cost. And when you look at how our data sort of breaks down, and this is just for the latest year's data that we've got, it's almost roughly, you know, a third in each of those categories. Okay, so but we've certainly got a good proportion, 41% in the good category for this year, that particular year's data. Okay. Right, let's have a look how that's calculated then. So this is going to involve milk produced and obviously the purchase feed. Relatively straightforward, so you need the amount of milk produced so you can arrive at your pence per litre figure. And then all the other costs of the purchase feed there, which we've covered off in the definition, but you can see it all broken down there. So then it's very simply, once you've gathered those together, it's dividing that purchase feed by the milk produced, again, times by 100 to get a pence per litre figure. Okay.
Yep.
Any questions around that?
No, that's okay.
I think that's fairly straightforward, isn't it? Yeah.
Yeah.
Okay. Right. Let's move on to the business financial measures then, and this is probably where it does get a little bit more involved. So we can say we'll go through as quickly as you want or as slow as you want, depending on what questions you've got. So Let's start with the full economic cost reduction first. Okay, so what is full economic cost reduction, or COP for short? Basically, it's all the costs of the dairy herd. So our optimal dairy systems will include the dairy herd and the young stock. It's all the cash costs, so the costs you pay out for, and you'll see coming out of the account, plus those sort of costs which you don't pay a check for, which is like the depreciation, the value of that unpaid family labour, any homegrown cereals and proteins that you might have that you feed to the dairy herd, and the potential rental value of owned land. So why have we included that? Well, very clearly, it's a key driver of profit, and I'll show you the evidence for that in a minute. What it also allows you to do, actually, when you look at the full economic costs, so not just those cash costs, when you look at full economic costs, you're able to then compare farms of different ownership structures and actual different systems as well. Because you can clean all those costs, it allows you to do that. And essentially, really, if you've got lower full economic costs, then you will be more resilient to the volatility that we'll see in milk price. Because if you can cover all your economic costs, you're going to have a successful business. There's no doubt about it, because you're covering everything. If you're able to get that price, that cost as low as you can, 9 times out of 10, you'll probably survive even when you get this volatility and low periods of milk price. So that's why it's a sort of crucial measure for us. Okay, so
Martin, can I just ask what you mean by the potential rental value of owned land? The potential rental value.
Okay, so if you are an owner occupier of your land, so you've got a parcel of land which you own, if you had to rent that land, how much would it cost you? So right. What's the local rental value for that land, basically? So it then puts that farm on a par with tenanted farms that obviously have to rent at least some of their land, if not all of their land. Okay, so it then gives you that easy comparison. Okay, but also it gives you it puts a figure in there of what you could say. You're looking at it as investment in your land as well. So a business, if you're going to grow and develop, you're going to be investing in land. So for those owner occupiers, it's almost like that figure for investing back into the land that you have. Is that okay?
Yeah, thank you.
Yep. Right. So what's the evidence for what we've just said? Well, so what we've got here again, it's 5-year set of figures. We've got dairy net margin along the bottom here, and the full economic cost of reduction up the left-hand side. And there, again, a very tight trend, clear trend that if you've got lower cost of reduction, you're going to have lower. I'm going to see if I can use this. So if you've got low cost reduction, you'll also have a better dairy net margin. Okay, so that's quite clear. And then when we look at the KPI ranges that we have, so we're saying that anything less than 25 pence per litre cost reduction is good. The middle range is 25 to 30 pence per litre, and anybody who's got cost reduction that are over 32 pence per litre is not doing so well. So majority of people are in that middle range, according to the sort of last year's worth of data, but we've got a quarter in that poor region as well. But encouragingly, there's 15% in that good category. So it is possible, and you can see by that chart on the left that there's a good portion there. We've got costs below 25 pence per litre, and you can see they're all making a positive margin. although down here we've got some very extreme ones where possibly they've just suffered from a very poor milk price. But the likelihood is you've got those low cost production, you're more likely to have a positive net margin. Right, so how do we calculate that? And this is quite an involved one, and I can understand this looks quite daunting when you look at it. So we'll take it step by step. So for full economic cost of production, you need your milk produced, your livestock costs, your variable costs, and your overheads. So firstly, amount of milk produced. That's fairly straightforward. You then need the purchases of your livestock, your heifers, cows, or bulls that you might have brought in. Then all your variable costs. So that's all your purchased costs, as well as your value of homegrown cereals and protein. So how would you work that out? Well, basically you take the market value. So if you had to sell that, so if you're selling, say it's wheat, if you sell that onto the market, what would you get price per ton for that? And apply a value to how much you grow. So that'll give you the value then of that homegrown cereals and proteins. All your forage variable costs, your fertilizer, seeds, etc., etc. All your vet and meds, any breeding costs, AI, semen costs, parlour sundries, chemicals, that sort of thing goes in there. And then all your sundry costs, like ear tags, bedding costs. If you contract out your heifer room, then the costs of doing that. So that will then be all your variable costs.
Can I just check with you, Mark? If you've got you talk about value of homegrown cereals and proteins. Now, obviously, that's assuming that you assign all of the cost of growing that into a different enterprise, which might be an arable setup. But if you're growing whole crop and you assign the costs of growing that to the dairy enterprise, then effectively it's the costs of growing it as opposed to the value of the end product.
Yeah, because there isn't so much a market, is there, for whole crop? There isn't necessarily a sort of price per ton that's normally paid for a whole crop. So yeah, in that instance, then it'll be the costs then of producing that whole crop, definitely. If you're just growing straights, your cereals, then you need to know obviously the quantity you've allocated to the dairy herd, and apply what would be the market price for that if you had to sell it.
Okay.
Thank you. Yep. Overheads. So this is including everything. So we've got labour. So labour is paid and unpaid, and again, use the standardised 30,000 per full-time unit. Power machinery, it's very straightforward, but we include depreciation as well. Administration is all your sort of office costs, general insurance stuff, professional fees, accountants fees, that sort of thing. Property costs will be like your water rates, repairs, any depreciation of your buildings, and then actual rent and finance charges. Okay, and then this rental value of owner-occupied land. As I say there, use local rent prices to sort of give a guide on what value you would put on that land if you had to rent it in. Okay. So that's what full economic means. It means including all those costs, including those imputed or opportunity costs, as we say, so that you've got a full look at what you're doing. And the other way to look at full economic costs is almost a sort of long-term view, really. So if you're looking at what a business needs to have in order to cover everything it wants, what it wants to get out, what it wants to invest in, this includes everything. And so, if you aim to try and have an income which is higher than your full economic costs, then you know that for the long term you're going to be successful. Okay.
Mark,
and then once you've got all,
can I ask a question here? If it's a mixed farm, and we have a lot of mixed farms in Scotland in particular, how would you split it? Would you split it as to the income received from, for instance, the beef enterprise compared to the dairy enterprise, and split it as a percentage that way, or is there another way in which you would split the costs between dairy and any other enterprise?
Yeah, it's a good question, because there's actually lots of different ways of doing it. What we've done with these strategic farms is that we've said what amount of time has these costs been spent with the dairy herd. So we've done it on a time basis. So yeah. So if for example, if you take labour and you spent 85% of your time on the dairy herd and 15% on some of your arable operations, then split your costs accordingly like that. That to me, I think is the most intuitive and easiest way to do it.
Okay.
There is other ways, and one of those is just simply proportionate in terms of land. What land has been attributed. So if you're looking at power machinery and it's been used across all the land, your dairy, forage area, your Alba unit, you know, what proportion of that land is attributed. So there's lots of different ways, but I think just keep it as simple as we can and just say what time is spent on your dairy herd versus your Alba unit. Okay. Farm bench will do it all automatically. So when we've got dairy and farm bench, that's all taken care of. So there's no thinking about how it's proportioned. You just put in your costs and it'll do it for you. So it makes it easy.
That's right. Thanks.
Is that okay?
Yep.
So once you've covered all that, it's then taking those livestock purchases, add on those variable costs, add on those overhead costs, and then divide by the total amount of milk produced to get your pence per litre, and that's then your full economic cost reduction. Okay. Yeah. Right. Let's move on to return on tenant type capital. So what's the definition of that? Well, that is basically dairy profit as a proportion of tenant type capital, or assets, some people call it, in which that is only related to what a tenant would own. So a tenant wouldn't own land or buildings. If they're full tenant, they wouldn't own land or buildings. So it's only looking at those assets which a tenant would own. So that would be machinery, it'd be livestock, it would be stocks of fertilizer, feed, it would be anything they've got in the bank in terms of cash, etc. That would be your tenant type capital.
Can I ask another question at the back of that? Some tenants will put up a shed and 50% owned, and if they ever move away from the farm, they will get 50% of the value of that shed moving away. Do you include that?
Yeah, that's a good question. I would, for this exercise, I probably wouldn't include it, because this is standardized as in not including buildings. So this is the standard sort of definition. So if they do part own a building, I wouldn't include it.
That's fine. I'm sorry for being a pain in the backside.
No, that's absolutely fine. No, absolutely fine. It's good to get these little nuances laid up.
Okay, thanks, Mark.
So what's the sort of rationale in terms of including it? What return on tenants type capital does? It looks at what's on the balance sheet, and it looks at the performance of the profit and loss, and it links the two together. So our previous indicators were all looking actually just at the profit and loss or management accounts. This is actually looking at both the profit and loss and the balance account and the performance of both. Okay, so it's a way of doing that. And it says there, it's a way of looking at how well are you generating an income from those assets that you've got. Okay. What it also does, it allows you to compare, again, across different farms and different systems. So it's one of these generic measures. And because, even owner occupiers would only have to put in their value for machinery, livestock and stocks, it means it's comparable. And one of the reasons we went for tenant type capital rather than all tenants or all capital or all assets is it means you don't have to sort of think of values for the land and the buildings if you own them. And that's, interestingly, it's not easy for everybody to be able to do that, actually, from our experience of collecting data. So it avoids that, that little thing. Okay. Any questions on that before I move on? Okay.
Mark, sorry to interrupt. David had a quick question just from previous slide about market value. He said, assume straw transferred from an arable enterprise would also be transferred at market value?
Yes. Yes, that's right.
Just to confirm.
Yeah, that's a good point.
Thank you.
Absolutely. Right, so what evidence we've got in terms of performance of those that have good return on tenant type capital? This is looking for the latest year's data, because that's the year we've got this type of data for. I've split this into just block calving and all year round, and you can see that those I've actually pulled out the top 5% in this case. They have a return on tenant capital of around 20%. At least 20%, so that's an average. So we've got some very good ones in there that have got a return of around about 30%, but certainly 20% is really good going. Top 25% you can see does vary between the block and the all year round ones, quite a difference there, with the block carvers actually performing better in that respect. And the same when you look at the average as well. But you can see from the average up to the best, there's quite a difference there. So again, if you're getting a high return tenant type capital, you're more likely to be performing overall better as well, and in that top quartile. So I think that's fairly straightforward, isn't it? Any questions? Okay. Right. So how do we calculate that? Well, we need the income, we need variable costs, overhead. We're going to calculate profit and then include those tenant type capital items. So the income is that, very straightforward, sales, income, and because this is looking at a profit and loss account, you'd include herd evaluation change as well. Variable costs, so it's all the cash costs in this sense, because again it's what will be on the profit and loss account. Overheads, the same there. What you would see on a profit and loss account. So then from that you calculate the profit, obviously income minus those variable and overhead costs. So that arrives then at your profit. So then we need to look at the tenant type capital. I think as I've been through, it's that value of the livestock, the machinery, any feed that you'd have in store, fuel and fertilizer as well, cash that you'd have in the bank, and anybody that owes you money as well. Include that, because that's what you own as well. So once you've arrived at your profit and you've got your valuations for those tenant type capitals, it's very simply then a question of dividing the profit by that capital and then times by 100 to get a percentage figure. Okay. Any questions on that? No?
No.
Right, okay. Right. We're on to the last one now. Last KPI before we have some fun with some questions. So, percentage of income retained. I'll just to say as well, for these slides, I put in some extra notes underneath the slide. So when you come to have a look at the slides, you'll see some extra information. I just don't want to put too much on the slides themselves. So percentage of income retained is very simply dairy profit as a proportion of total income derived from the dairy herd. Okay, and the dairy profit is the same as the profit we've calculated for the return on tenants type capital. And why is this important? Why we've included this? And I mean, it's argued that this is the ultimate measure of the farm's ability to reinvest in itself and grow. If you're not retaining some of your income after you've taken your costs off, how can you reinvest, etc.? Because that income has got to pay for things. That income that's left over has got to pay for loan repayments, tax, and private drawings. So getting some income from that for personal use. And it can be considered a sort of day-to-day KPI. How much of that income that you're generating can you retain? So that's why I feel it's important to include it. It's a measure of profitability. It's not a measure of cost reduction, it's a measure of profitability. So it's important from that point of view as well. And again, if we look at our figures from the last 5 years average, again, we can see some very stark differences between the average and the top performers. So those top guys will be getting around 30% of their income being retained, and there's a few in there that are getting higher than that. But on average, for that top quartile, top 25%, they're retaining almost a quarter of their income after take off those costs. So again, hopefully quite a sort of clear argument of why income retained is an important KPI. So how do we calculate it? So income and the variable cost and overheads is basically calculated all the same way and includes all the same things as you would for calculating return on tenants type capital. So the profit figure would be the same. All you're doing is saying what percentage of that profit is of the income. So it's profit then divided by the income times by 100 to get the percentage figure. Okay, so in this case, they're retaining that profit of 28,000 is 6.7% of their income of 415,000. Okay, is that clear for everybody?
I think so.
Yeah.
Should have had more coffee before we started.
You're only in coffee.
Yeah, perhaps you're right, Ian.
It's Friday, you've all hit the wine or gin.
Yeah.
Okay, as I say, you can have these slides, look at your leisure and go through, and you can always come back to if there's something that still isn't clear. Okay.
Yeah, it's good how you've laid it out though, Mark. And then perhaps say if like anybody's got like a businessy type discussion group coming up or something where it might be interesting to compare different members, say with like the percentage of income retained, then they could people just have like a chat with you before, like a 15-20 minute chat just to get it in their heads properly for a specific one of these KPIs or something.
Absolutely, yeah, no problem at all. Yeah, if you just want to go over it or refresh what we've gone over today, no problem at all. Just drop me a line. Okay. Right. Well, that is all the KPIs. And I thought now to end the session, we'll have a fun test or quiz.
You should have put quiz, not test.
Yeah, I sort of thought that, really, but I thought this probably puts the pressure on a bit. Call it a test. Don't worry, it won't go towards any performance review, but it will hopefully just help you in terms of retaining some of that information. Trying to incorporate some different learning styles, of course, as we're told we should be doing. So let's see we get on. So we've got 10 questions.
9 questions.
Oh, is it 9 now? Is
9.
It?
Yeah, 9.
Okay, 9 questions, all covering those KPIs. So yeah, should we rock and roll and start and see how we get on?
Okay, yeah, and just to say, like, we can't see what anybody's answers are or anything, so don't worry about what you answer or anything. It is just to do something a bit different. So here is the first one.
So let me just, so first question is, in optimal dairy systems, is total purchase feed cost a business financial measure or a dairy enterprise KPI?
Okay, so get your votes in. It's counting down, got 20 seconds, got about, yeah, we'll give it another 20 seconds.
There's a timer involved as well, is it?
There isn't actually, it's counting up rather than counting down, so it's just when we feel like we've given people enough time. Okie doke. Right, going to close that one now and show the thingy. Right, which is the correct answer?
So the correct answer is that total purchase feed cost is a dairy enterprise KPI. Okay. And the majority got that right. That's good.
Super. Right, number 2.
So, does total purchase feed cost include purchase forage? Simply yes or no. Does total purchase feed cost include purchased forage?
Okie doke, that's complete and 100%.
100% yes. Yep, that's the right answer.
Yes.
Brilliant. Okay. Next question.
Okay.
Right. Question 3. Are rent and finance costs used in the calculation for the overheads as a percentage of income KPI? Yes or no? So do we include rent and finance in calculating that overheads as a percentage of income KPI?
Might get some music to put on the back of these votes, like countdown or something.
That's a good idea. Yeah.
Can you sing? Can either of us sing?
I just hum it every time.
It feels like Who Wants to Be a Millionaire?
Yeah.
We should have an incentive of some cash prize, shouldn't we, Ruth?
Oh, I've lost out already.
You get a pay rise. You get a pay rise if you get it all right.
Yay!
Okay, so the majority of you say no, it isn't included, and you'll be right. Rent and finance isn't included in the calculation for that particular KPI.
Okay.
Okay.
Right, super. Okay, number 4.
So, question 4. What value of unpaid family labour per full-time equivalent is suggested to be used in the calculation for the overheads as a percentage of income? So what did we say was that that value we should attribute to unpaid family labour when we're trying to calculate the overheads as a percentage of income?
Everyone was really quick on that one.
Oh, they are good.
Yeah.
And I can just see 30,000 is the correct answer. So well done.
Marvellous.
Question 5. So what is included in the full economic cost of production KPI, which isn't included in the total expenses of a comparable farm profit calculation? This might be a little trickier one, but so what is included in full economic cost of production, but not included in calculating comparable farm profit? So unpaid family labour, depreciation, and livestock purchase, or value of homegrown cereals, rental value of owned land.
Bit more thinking time on this one.
Yeah, yeah. This is a tougher one. I agree with it.
Oh, I've answered the wrong one.
Maybe Mark, you just give us a little bit of a description as to why, just as a reminder on this one when we have the answers in.
Yes, we'll do. Yeah, I was just thinking that actually because it's worth to know. It's worth knowing. Okay.
Just going to hang on. We've just got a couple more votes to come in.
They're checking their notes, are they?
Yes. 80%. A few more, I think. One more.
I forgot to hit the submit button.
Oh,
I was concentrating that hard. Thinking. I couldn't multitask to hit the button as well.
there we go.
Brilliant. Well, that's really good, because the majority of you got it right. It is the value of homegrown cereals, rental value of owned land. That's the correct answer. So basically, in full economic cost of production, we want to include everything, because it allows you then to look at comparing across different systems and farm types, whether you're tenanted or owner occupier. So if you include those values of homegrown cereals and proteins and the rental value of owned land, you're able to do that. Okay.
Okay, great.
Right. So, question 6. Is the full economic cost of production KPI, in terms of the optimal dairy systems, is it for the whole herd, i.e. the cows and young stock, or just the dairy herd, i.e. the milking and dry cows? So in the optimal dairy systems, is the full economic cost of production for the whole herd or just the dairy herd?
Just 2 more votes. Okay.
Correct. Yep, everybody's right. It's the whole herd. Brilliant.
Oh, we're a bright bunch.
You are. You're quick learners. Question 7. You're going to get gold stars for this, I think. Question 7. Does the profit figure used to calculate the return on tenants type capital use a herd replacement cost? So do you remember whether I talked about herd replacement cost in calculating that profit figure for the return on tenants type capital? Simply yes or no.
Can you have a simply don't remember as an option?
Yeah, I should have done that on all of them.
Yeah. Oh.
You don't pick them both?
Yeah.
It's quite close on this one, so I think maybe everybody's a bit.
That's good. That's partly why I put it in. I had to put something in there that would throw you a bit.
Just one more vote. There we go. Oh, look at that. Brilliant. 50-50.
I think we all simply don't remember.
And you probably don't remember because I didn't mention it. So the answer is it isn't included. Yeah, it isn't included. So a herd replacement cost is a calculation that you use if you are just looking at the enterprise. So if we were just looking at the dairy herd, you're not including young stock in that, in the cost of the young stock. But what you still need to do, you need to account for those young stock coming into that dairy herd, whether you purchase them, whether they bring in your own. And to do that, you calculate a herd replacement cost. Okay, so for return on tenants capital, we don't need to do that because we're looking at the whole herd, because the whole herd includes the cost for the young stock already. Okay, is that clear? Is that clear as mud? Okay.
Just say it once more. Just say. Can you just say it once more, Mark? Just to double sure. Thank you.
Okay, I'll say it the other way around. See if that makes it any clearer. So when you're calculating your profit figure for return on tenants capital, that profit figure is using your costs from the whole dairy herd, young stock and the milking cows. Okay, so there's no internal transfer of anything because all your costs are already included. So you don't have to put a transfer value of your heifers, your heifer calves leaving to go into the heifer rearing unit, for example, and then those heifers coming back into the dairy herd, because you've got all your costs there already. That's it. When you're just looking at, say, the dairy herd, so you just look at the milking herd, you don't include the costs of rearing the young stock, but you still need to account for those young stock coming in, those heifers coming in and calving. So what you do, you calculate a herd replacement cost. So you're replacing those heifers that come into that dairy enterprise.
Okay.
So in effect, it's calculated for you already.
Yeah.
So they're both right.
They're both right. They're both, yeah. Well, they're not right in the sense that you don't have to put a value in those young stock coming into the whole herd, because the costs are already there.
It's okay, Mark. I'm just grasping at straws.
All right. Okay, should we go on to question 8?
Nope. Sec.
Right. So question 8, does the return on tenants type capital KPI calculation use the value of land? So did we use the rental value of land in calculating return on types capital? Does it involve the value of land, full stop? So think about what is tenant type assets. You're a tenant, what do you own? So the majority are right, yeah. The value of land isn't included because a full tenant wouldn't have that land as an asset. Okay.
Okay, thank you, Mark.
And is it the last one now, is it? Question 9?
Yeah.
Okay. So question 9, is income, a percentage of income retained, a measure of profitability or cost of production?
It would be nice if we got 100% for the last one, wouldn't it?
It would be good, wouldn't it?
Pressure.
And if you're listening carefully, I did say. This percentage of income retained, a measure of profitability. And, nearly.